Hello and welcome to the ETF show. Joining us now from Franklin Templeton to talk about dividend investing is head of U.S. ETF product strategy and development, Todd Mathias. Well, Todd, first, how are investors currently considering equity dividends now that they can once again find income from more traditional sources like fixed income?
First off, thanks for having me. Looking forward to the conversation today. I find it helpful to really put this into context around the income that can now be earned from fixed income or even money market products. If you actually look at, let's call it a $500,000 investment and the monthly income that could have been earned, you go back to COVID lows, a traditional investor was making somewhere around $170 a month through that $500,000 investment in US Treasuries. If you actually now fast forward to where interest rates are today, that's actually north of $2,000. So there can be ample income earned from fixed income that puts into question one of the largest segments in ETF investing. That's actually more than $400 billion, which is the dividend category, and how that portfolio context may shift. So if you're actually to go to a typical investor and ask them how they use dividend ETFs in their portfolio, they're going to rattle off a number of different characteristics that make sense. That could be income, could be defense and stability, could be capital appreciation, could be quality, could be just the end investor perception of really enjoying seeing dividend in the name. The stack ranking of those attributes will shift based on market conditions as well as the objective that advisor, the end client, is seeking. What's been challenging has been these market conditions. And when you have potentially significant concentration in certain sectors that haven't been doing well in the growth environment, whether that's financials or utilities, or you have stringent rules in the product design that require certain growth characteristics, these products haven't been able to keep pace with these changing market conditions. What's helpful is that nonetheless, product innovation in the ETF space has been moving alongside these Generation 1 and Generation 2 products to provide more ideal outcomes for the end investor.
And despite recovered fixed income markets, Todd, why are dividends still an important part of a portfolio?
Yeah, I mean, again, you look at these interest rates that are potentially going to be staying elevated to allow investors to produce ample income for quite some time. But there's some key drivers that make dividend investing still important for the client. If you actually look at a recent survey from Gallup of over 700 investors, inflation remains the top concern amongst these investors. It's actually even over crime, over homelessness, over some rising costs in other areas. And you look at those rising costs and you put them in perspective that we've seen since COVID. You look at motor vehicle insurance, it's up 46% since COVID started. You look at medical and healthcare, that's up 10%. So with these increasing prices of goods and services that we all consume, you have to keep pace in your portfolio. So you have to look at the stability of your capital appreciation. So dividend ETFs can really help investors during those volatile times. They're typically companies that are more blue chip in nature. They tend to have more mature business models. And then you can also then produce that income. That really helps offset some of that downside volatility that can be coupled with what you see in an inflationary environment. So let's move that income production with capital appreciation, and you have a really nice all-weather portfolio tool for that end client.
Why are U.S. investors turning to international dividend solutions such as DIVI or ticker DIVI?
Yeah, I mean, I think if investors look at the composition of today's U.S. market, it's really tech heavy. There's a lot of concentration in the largest names of the U.S. large cap market. That natural stepping stone is going to be into developed non-U.S. or international markets. These tend to be very global companies, and they also have paid higher dividends than U.S. companies. DIVI, in particular, an ETF from us, has seen a lot of interest really attractive asset flows. And it's that ideal blend of income and capital appreciation while being responsive to the changes in market conditions. So if you actually create a portfolio of securities that target representation of the overall market while still enhancing the income experience for the investor, you allow for strong upmarket participation when you have so many non-payers, you have new payers, and you have low payers that are today's market leaders.
Finally, Todd, I see core in DIVI's name. What about this product makes it suitable for that part of a portfolio?
Yeah, so the index that DIVI tracks, as mentioned, is built to look and feel like a traditional passive exposure that many investors use at the core of their portfolio. That coupled with market exposure coupled with income at only 9 basis points makes DIVI a really attractive core allocation.
Well, Todd, thank you very much for joining us.
Thanks again for having me.
And thank you to everyone watching. Once again, that was Todd Mathias with Franklin Templeton. And I'm Jenna Dagenhart with Asset TV.